Good morning, and thank you for joining Moneta Gold's preliminary economic assessment webcast and conference call on the company's 100% owned Tower Gold project. At this time, all lines are currently on mute to prevent any background noise. I would like to remind you that this conference call is being recorded today and is also being webcast on the company's website at www.monetagold.com under the Investor section, Events. Analysts and investors are reminded that any additional questions can be directed to the company at larmstrong@monetagold.com. This call contains forward-looking statements which reflect the current expectations or beliefs of the company based on information currently available. Forward-looking statements are based on the current opinions and expectations of management. All forward-looking information is inherently uncertain and subject to a variety of assumptions, risks, and uncertainties, including the speculative nature of mineral exploration and development, fluctuating commodity pricing, competitive risks, and the availability of financing as described in more detail in our recent securities filings available at www.sedar.com. Actual events or results may differ materially from those projected in the forward-looking statements, and we caution against placing undue reliance thereon. We assume no obligation to revise or update these forward-looking statements. Moneta has included certain non-IFRS financial measures in this news release, such as initial capital costs, sustaining capital, cash operating costs, and total cash costs, all-in sustaining costs, all-in costs, profitability index, and peak investment, which are not measures recognized under IFRS and do not have a standardized meaning prescribed by IFRS. As a result, these measures may not be comparable to similar measures reported by other corporations. Each of these measures used are intended to provide additional information to the user and should not be considered in isolation or as a substitute for measures prepared in accordance with IFRS. At this time, I would like to hand the call over to Gary O'Connor, President and CEO. Please go ahead, Mr. O'Connor.
Thank you, and welcome everybody to this morning's company broadcast and webinar on the recently completed preliminary economic assessment study. It's long awaited, and we're very pleased and happy to be releasing that today. I'm present here today with the management team, so it's the project delivery team. Mr. Jerry Rogers, VP Projects, will also be contributing to the presentation, as will VP Technical Services, Jason Dankowski, and we have the Vince Deschamps, Director of Sustainability, Adam Kashishian, VP Corporate Development, and Jason McIntosh, CFO, who are also available here for questions and further details should anyone have any questions. So thank you, and we will move forward. There are forward-looking statements as previously described. The Tower Gold PEA highlights. We're really quite excited with this. We have an after-tax NPV, 5% discount rate of $1 billion and 66 million Canadian dollars. We have an IRR of 31.7 at a base case $1,600 US gold. Our total cash costs of $910 per ounce. This is life of mine, and $1,073 all-in sustaining cost, again life of mine. We have a robust payback period, 2.6 years, and we're highly leveraged to the gold price. So at today's spot price at $1,700 US, the project has an NPV at a 5% discount rate of 1.339 billion Canadian dollars and an IRR of 37.8. The PEA outlined a production scenario, life of mine production of 4.6 million ounces, an average of 261,000 ounces a year for the first 11 years, processing 7 million tons on average. That's just over 19,000 tons per day over the 24-year mine life. Peak production is in year 6, 368 100,000 ounces in that year. We are mining both underground and open pits, blending up to 900,000 tonnes per annum from underground. The first 11 years, we have an average head grade 1.28 and a life of mine of 0.94. The initial capital, we've managed to keep this well contained. It was 517 million Canadian. We have pushed back as much capital as possible to reduce that. So we have more capital coming in over the years, including the development of the underground and the ramp construction there, as well as pushing back some of the equipment costs. And Jerry will be going over that in some more detail. So sustaining capital of 886 million life of mine and a total life of mine capital of 1.4 billion. We have a profitability index of a very attractive 2.1, and the peak investment is at 517 million. The opportunities we see, which we'll be looking at during pre-feasibility studies and feasibility moving forward, we do have the ability to expand the underground resources. We've only have underground resources in this study at Westaway and Southwest. We see ability to expand there and elsewhere. We see the ability to expand the throughput, and we will be reviewing any bulk tonnage mining scenarios going forward. At the moment, we have high-grade ore coming in through years 11 to 12 from underground, but there is the ability, we think, to expand that. We also have the ability to do a mill expansion at this stage. That seems to make the most sense at around year 11, but that's when the current underground closes, but we will be looking at options there. We have the ability to infill the pits. There is waste in our pit areas at the moment. There's high-grade areas that are open. We are drilling in there now. We are converting and infilling the pits. And we also have the ability for optimization of the project site layout. Remember, the Tower Gold project occurs in the highly prospective Timmins camp, 100 kilometres east of Timmins. We own 100% of the assets. And all of the resources are on patented mining claims, so we own both the surface and underlying mineral rights. There's no royalties over the Golden Highway portion and about a 1.5% royalty over the Garrison portion of the resources, of which we can buy back about 0.5%. The project occurs on a major highway, Highway 101. It's 100 kilometres east of Timmins. We have a sizable land package in the area, so we have the option to, for plant site and site optimization, utilising a large part of that land package. We also have a number of other projects where we think we can add additional high-grade ore to the project moving forward. Looking at the base case summary, and this is, remember, at $1,600 gold, at exchange rate of 0.78. We have a pre-tax NPV of 1.459 billion, after-tax 1.066, pre-tax IRR 38.9%, 31.7 after-tax. As mentioned, the attractive initial capital, the sustaining life of mine 866 for a total of 1.4 billion. We have closure costs of 78 million and a very healthy 2.6-year payback. Life of mine cash costs $910 US, and life of mine all-in sustaining costs $1,073. At 7 million tonnes per annum, this is a 24-year project. There's 166 million tonnes processed in the life of mine, 4.6 million ounces payable, average life of mine 0.94. Remember, the first 11 years are at a grade of 1.28, producing 261,000 ounces a year. And we're looking at overall life of mine production of 193,000 ounces a year, which, as mentioned, we'll be looking to do expansions of the production and expansion of the underground to increase that after year 11. As previously mentioned, the after-tax NPV at a 5% discount rate is at 1.06 billion. We have, in addition to the 166 million tonnes of feed, there's 495 million tonnes of waste. The hard rock waste is a 3.13 to 1. Strip ratio, including overburden, is 4.63. The payback during pre-tax is 2.2 years, which is extremely healthy. Internal rate of return of 38.9% pre-tax. Remembering that after tax, we're at that 31.7 at a 2.6-year payback. Life of mine Annual cash flow, $105 million. Cumulative cash flow for the life of mine is $1.93 billion. And that peak investment is at $517. This is the most we'll need to raise at any point in the life of the mine, of the project. As mentioned, the economic results show a 1.28 head grade those first 11 years, 91.3% recovery, annual mining of 19,000 tonne per day, producing 261,000 ounces a year for the first 11 years. A total production 4.6 million ounces. Mining costs a total of including reclaim, $3.70 Canadian an ounce. Total processing costs, this is $10.10, and total mining and reclaim of all of the resources of 20.8 for an average of 31.8 of milled cost on a per tonne basis. We also have a $4.70 per ounce refining, and remember there's 1.5% royalties on the Garrison deposits, but 0% royalty on the Golden Highway. The cash flow, as mentioned, it's a 2.6-year payback after tax. This is the post-tax cash flow. 103 million average life of mine, 1.9 billion life of mine total after tax cash flow, 2.1 profitability index, and a peak investment of 517 million. We've attempted to push as much of the capital back into the sustaining as possible, and we feel we've done a good job doing that and keeping our initial capital down and maintaining a better payback period and sequencing the operations to maximise the return to our investors. Looking at the gold sensitivity charts, we used a base case 1,600. At today's gold price, at 1,700, the after-tax NPV sits at about $1.34 billion. That's a 37.8% IRR, and a profitability index 2.6, and a payback period of 2.2 years. Looking at other sensitivities, notably in regards to the NPV, and this shows a range from $1,350 US gold price. We still have a very robust project, and at over $2,000 an ounce gold, we're looking at with a $2.4 billion after-tax NPV. At IRR at that same price, over $2,000 is 60%, and yet we're at economic all the way down to $1,350 and beyond. So it's an extremely robust project, and we see this as a strong project moving forward. Looking at the graphs, this really highlights that the main factors that are most sensitive in the project is the gold price and the grade. The economics are less susceptible to capital costs and operating costs. We feel the project can easily absorb increases in capitals and operating costs, and as shown, the project is extremely profitable all the way down to significantly lower gold prices. On that note, I will hand you over to Jason Dankowski, the VP of Corporate Services and Geology, and he's going to go through the mineral resources and mine plan section.
Thank you, Gary. Good morning, everybody. So starting with the foundation, our resources. So, what we've done is we have actually optimized our resources from our May-June press release back in May and June. We're now at a total resource of 12.75 million ounces. 10.99 million ounces of that is open pit, 4.3 million of which is indicated. 1.76 million ounces in underground is also included. These optimizations that we've included since May and June include, so what we identified at the Golden Highway deposit was that we weren't capturing the north-south veins, the grade properly. These are higher grade extensional veins in our deposit. So what we've done is actually we've re-rotated our block model from 330 degrees to a north-south orientation so we can capture the grades of these particular structures much more effectively. We've also changed the block size to also reflect these north-south veins, which both of these would have contributed to a grade increase. And then we've also included additional domains at our southwest deposit and as well within the banded iron formations within our deposit. We've also updated the recovery at John Paul, and then we reran the 1750 pits to give us this increase in our resources. So that increase totals in and around 991,000 ounces, 195,000 of which was indicated, and 796,000 of which was inferred. Most of this increase came from Westaway and Southwest at the Golden Highway deposits, with a smaller increase coming from John Paul and Garrison. The grade also increased slightly by about 2%. So in our resources, we used the base of 1750 gold, a 0.78 exchange rate. We use variable recoveries from each of our pits based on the metallurgical samples that we have. The average NSR royalty of 1.5% was applied at Garrison, on the Garrison deposits, and then we calculated 0.22 and 1.3 cutoff grades. However, we utilized a 0.3 and a 2.6 for underground grams per ton cutoffs for our resources. So this figure here is showing our new resources at those cutoffs at 0.3 and 2.6. Noticeable here is how much resources have been pulled into the open pits. And then I'll just take you through the deposits here. So top left here is Golden Highway. Starting from the top left, you've got 55 Westaway, then Southwest, Windjammer South, Windjammer Central, and then up north into the Discovery and Windjammer North zones. On the bottom right of this figure is the Garrison, which includes 903, John Paul, and Garcon. So moving from resources into mine planning, what we've done is we've used Whittle to optimize our mine plan, or our open pit mine plans, using a gold price of $1,600, and a foundation on delivering three key values to our pits, which one is a lower strip, higher grade, and third one is maintaining a profit margin in each of these scenarios. This resulted in the identification of starter pits at the Garrison project, Garrison portion of the project, at all three, 903, Garcon, and John Paul. Each of those have two phases in their mine life. And then we transition into the pits at Westaway, Southwest, Windjammer, 55, and then we finish off with Windjammer South, at which point we then develop the Windjammer Central and Southwest Phase 2 pits, these coming in after year 11 for our mining sequence. I should mention, 158 million tons come from open pit at a grade of 0.81 for 4.11 million ounces and a strip ratio of 4.6. It's important to note that 1/3 of that strip is overburden. Without the overburden, the strip ratio actually reduces down to 3.1. Underground is driven from a single decline from surface before splitting into two ramps, one supporting the Westaway underground and a second supporting the Southwest underground. Ores from long hole open stoping, minimum 3 meters wide, averaging 9 meters. The mine-to-mill analysis identified a plant of 7 million tons per annum was optimal. For our mineable resources, resulting in a 24-year mine life. Mine sequence started at the Garrison pits, as I mentioned, which includes the starter pits at 903, Garcon, and John Paul, followed by the second phase of each of those pits. And then we go into the Southwest, Westaway, 55, and then Windjammer South, and then a second phase of each of those pits, following in the years 12 plus. Open underground is mined concurrently from years 1 through 12 at a rate of 900,000 million tons per annum, or 900,000 tons per annum. Grade drops off after year 11 when that underground finishes, and we move into this two pushbacks that are independent at the Windjammer Central and Southwest. Here's a more detailed look at the contributions over the first 11 years. Highlights on this slide include 261,000 ounces recovered annually over the first 11 years. a head grade of 1.28 over the first 11 years. Garrison open pits starting at 1.24 and 1.27 in years 1 and 2 during our payback period, before moving on to John Paul, followed by higher grade pits at the Golden Highway for an average of 1.05 grams per ton over the first 11 years, and then underground ramping up to full production in year 3.
Thank you, Jason, and I'll now hand it over to Jerry Rogers to give an overview of the mine development plan. Thank you.
Thanks, Gary and Jason. Jerry Rogers here, VP of Projects. Coming to some costs. The PE was put together, I would think, through a collaborative effort through Ausenco, Mining Plus, and Moneta. Moneta has put together a pretty strong technical team. Jason Danowski and myself both worked on mines for a long time, so we have a deep knowledge of costs, so as well as Ausenco and Mining Plus. So these costs were put together with 3 consortiums, and I feel pretty comfortable with our costs. Maybe I'll put some color to these costs right now. The difference between Golden Highway and Garrison is strictly Golden Highway has a longer haulage to the plant, and that's basically the only difference in the cost per ton mine. Some of the P&A costs are in the processing costs. We decided to do that way based on how each area turned out. So if we took them out, the G&A costs would be a little bit higher. Gary's already talked about the cash costs. Moving to the capital costs, we've had quite a bit of conversations with the Moneta team and our suppliers on the capital costs. We bulletproofed them, we benchmarked them. On the initial capital costs, we're a little bit uncomfortable because it just seemed low, but it seemed to come in pretty on par with other mines around our area. When you look at the capital costs, you need to harmonize the initial and the sustaining, because the sustaining carries on through the life of mine, and a lot of that sustaining comes in year 2 and year 1. So is the initial capital cost low? I don't think so. I think it's right on, but we need to look at the total of the life of mine. Some of those capital costs were pushed into sustaining, as well as our equipment is leased, so you don't see that in the first year. Some of that's seen in operating. So I think the capital costs are appropriate, but the initial capital costs could seem a little low, but I think it's appropriate. Next one, please, Mary. I'll look at 7 million tons per annum. Gary's already covered that, 24-year mine life. You can see the split between open pit and underground. A big reliance on open pit, but the underground has got the 3.5, 3.7 gram per ton. Meanwhile, the open pit's got the 1 to 1.2. Pre-stripping of overburden is capitalized. As I said before, our equipment is leased with a down payment. Underground, a 3 meter minimum width. It's wider than that, but that's the design criteria. The average is 9 meters. And underground's got a 12-year mine life. We're hoping it's longer with Jason's drilling in the next year. Underground needs to ramp up. We need a decline. And we may put that decline down sooner, but right now in the PEA, it's got a 2-year ramp up. We decided not to go with the camp. We've debated that a couple times, but I think it's in a pretty good area where we don't need a camp. We can probably draw the people in. I think that's it for the color on this slide. Gary's covered quite a bit of this already. Next, please. This is the site layout. You can see the Garrison side is to the east, and the Golden Highway side is to the west. Just a few things on this one. The little small black dot on the Garrison side, on the east side, is where the plant layout's going to go. A good position for it. It's got access. We start mining with Garrison. The PA has Garrison started first, so it's right near the plant. And of course, that big black mass towards the southeast is the wet tailings area. So it's the closest to it. So it's the right place for a plant to be, and it's totally within our plan and claims. So that's fantastic. The tailings storage facility is down to the southeast. Like I said, We also were a little uncomfortable with that area, so we did a trade-off study with dry stack. It's not shown on here, but we do have that dry stack study, and we'll definitely carry that dry stack on to a PFS as well. We don't want to strictly rely on a wet facility, just in case we have to go to dry stack. It's away from streams. The east side, Garrison side, we constrained some of the pits to stay away from the streams, so that's good for all key stakeholders. And the test work shows no area or deleterious elements. We are going to backfill underground with tails. It is the PA and supported myself is top down, so it's going to have paste fill. We have no development of north of the highway. And there's potential to backfill the pits. In fact, some of the pits are backfilled with the tails. And it's got a pretty small footprint, as you can see. It's pretty tight on the Garrison side, and it's also tight on the Golden Highway side as well. So that leaves us with a very small footprint and room to grow.
Okay, so for opportunities on our project, first and foremost is drilling out of these open pits. So within the pits, there's a lot of gaps in our drilling in order to bring out where we have opportunity to convert waste into ore, particularly at Windjammer Central, Southwest, and Westaway. We have the opportunity to extend our high grades within our open pits, so there's opportunity, within the banded iron formations, within Southwest. These do have some open resources within our pits. Expansion of the underground resources. So as Gary mentioned earlier, Westaway has strong potential to be expanded at depth with continued drilling. Additional resource potential at Tower Gold project. So we have 8 kilometers of untested strike length within our project. And then potential targets outside of the Tower District. So these include other claim project areas that are within 30 kilometers, which includes Burks, which includes the Burks project and Bafanta. And then we've also got sampling of unsampled core. So particularly in the Garrison project, our mineral resources, a lot of it has unsampled material within the drill core. Historical loggers and geologists were searching for high-grade underground targets back in the early 90s. So therefore, they selectively sampled these holes, looking for anything over 2 grams a ton. So there's a lot of material that is, below 2 grams a ton within this core that hasn't been sampled yet, and we're currently treating that in our resource with 0 grade. So we're going back, we're resampling this historic core. And if we can't find that historical core, we're going to probably re-drill it to remove these holes from our resource so we can improve the grade within those deposits. There's high potential in improvements at Garrison. And I'll hand it up back to Jerry.
Great. Let me talk about the underground bulk tonnage. There is potential, not with our PE right now, but PFS to further study bulk tonnage underground. It does seem to widen underground, and we will be looking at that. Especially with Jason's drilling, when we get to drilling underground, we may actually increase that. So I'm pretty bullish on the underground bulk tonnage. There's a lot of work to do in metallurgical recovery. I'll be issuing an RFP very soon to do that, especially in the refractory John Paul. There's environmental test work to do, but we do have low sulfide rocks, high carbonate rocks. I don't think there's any danger there, but we got to do the work anyways, and that's coming very soon. There is room to maneuver on the plant, on the site layout, especially on the Garrison side. We may move the plant slightly to the west or slightly to the east, but we still need to do some work on there in the PFS. I think Jason talked about the last two points, which brings us to next steps. I think, Jason, if you want to take that first one. We have to upgrade infill resources in the PA. There's 60 to 100,000 meters to drill on our resource on the first step. We need a mineral resource update. Very soon, we'll be releasing an RFP for metallurgical test work. The environmental baseline is already going on, as well as community engagement. Those 2 things are already going. Those are ongoing, but they are going to be reinforced very soon. We need to start an IA very soon. That's really H2 2000. That's the next step under the PEA column. The PEA is completed. The written portion will be completed in the next 45 days. Jason, with that comes the mineral resource update, as well as expand infill upgrade drill program, which is ongoing right now. Very rigorous program. We're going to start early studies for the PFS, which include geohydrological and hydrological work, as well as surface hydrological work, metallurgical work, and geotechnical work. That's going to start very, very soon. And when I say soon, it's weeks and months, not quarters. We've already talked about the hydrological test work and the metallurgical testing for things like ARD and stuff like that. So that's going to start very soon. That's really our next step, is to get that RFP out, and I think that work's going to start in October. Which brings us to the first half of 2023. Again, we'll still be drilling. Jason Danelski, VP Technical Services, is still drilling. So that on goes for the first half of next year, almost probably all next year. And as well as the studies for the pre-feasibility study, those are ongoing next year. And we're going to be increasing our team slightly in anticipation of finishing that PFS up and getting deeper into things like the IAs. So the completion of the pre-feasibility study is going to be going probably to 2024. Parallel with that will be the environmental impact study, which is not going to be finished in 2023, 2024. That's going to be finished later on, maybe 2026, but we're starting it very soon. And probably the feasibility study will come a little bit later.
Thank you, Jerry, and I'll just give a wind up now of the presentation. And part of that involves just comparing now some of our costs, notably our operating costs, with other operating mines, similar rocks, some of these are actually of similar scope and size within the camp. You see we're sitting very much both from a cash cost and an all-in sustaining cost with many of our peers in the camp. Remember, that's that $910 US per ounce cash cost, $1,073 US all-in sustaining cost. And looking at other Canadian, development projects, we were trending, and where we were coming in regards to capital costs, where we're coming in regards to overall gold production on a per annum basis. We're well positioned and been over 260,000 ounces a year the first 11 years. Our initial capital, and these are in US dollars. We're well in line with our peers, and remember, we are, as Jerry had mentioned, we've pushed some of our capital into sustaining. This helps the overall economics, our payback, and this has resulted in a good, attractive profitability index. That's a good measure of our profitability and paying back that capital. Remember, it's a 2.6-year payback post-tax, and a lot of this is, of course, possible due to our great location, and it's competitive advantage being beside a major highway and a major mining district. And we look forward to moving the project forward. As Jerry mentioned, we've already started the PFS drilling, the resource upgrade drilling, 60,000 meters into that, and we'll be continuing that drilling, commencing the PFS studies and moving that through and looking to have that well advanced through the remainder of this year and into the end of next year. So we're highly encouraged to keep the project going. We now have a very solid project and very robust, and we're looking to continue to, provide a good return to our shareholders and all of our stakeholders. And thank you for that. And if we're welcome to, make questions now, and happy to take questions from the audience.
Thank you, sir. Ladies and gentlemen, if you would like to ask a question, please press star followed by 1 on your touchtone phone. You will then hear a 3-tone prompt acknowledging your request. And if you would like to withdraw from the question queue, you will need to press star followed by 2. And if you're using a handset, we do ask that you please lift before pressing any keys. Please go ahead and press star 1 now if you have any questions. And your first question will be from Sahaj Anand at IA Capital Markets. Please go ahead.
Hi, Gary and team. So first of all, congratulations on the phenomenal PEA there, and truly congratulations to the whole team. It's a great report. I had a question about like potential expansion scenarios. Like you did mention, like you would be looking into, I guess, plant expansion scenario. Maybe could you please maybe add a bit more color on that? Like, would it be something which is a larger plant from the get-go, or would it be a phased development approach, or like something which you would be looking to, fill the second half of the production profile? Like I'm sort of thinking on the lines of Artemis, Blackwater, how they have done. Is it something like that, or maybe you can add some color on that?
Thank you, Sahaj. Yeah, in answer to that question, at this stage we have looked at, expanding the plant at, after year 11. That's when the grade decreases, and that's due, completion of the underground resource that's currently defined. We could have put that into the PEA as an expansion at that point, but at this stage it doesn't affect the economics much because it's out in years 11, 12, so your current NPV is really based on your first 10 to 12 years of production, which we've shown. So what we're really looking at in regards to that is increasing the profitability of our current pits, so reducing the strip where in and around areas where we have good grade. As you can see, the first 10 to 12 years, we have an average grade of 1.28, and the open pits have grades up to 1.3 in some of those earlier years. So we're looking to expand that, notably 903. We're in there drilling now. Remember, we have 2 years there at about 1.3 grams per ton, and we also have the ability to expand the underground resources. We've got Westaway is wide open. We put a press release out on that recently that showed expansion beyond our current resource. The same with Southwest. We had a press release out about 6 weeks ago that showed expansion of ore grade intercepts outside the current resources. So we'll be looking to expand the underground and using the same throughput, but increasing our the amount of ounces that are produced in the mine plan. But we have every opportunity to, once we've paid back the current capital, to expand throughput and capture more ounces.
Gotcha. And maybe just one more on the permitting side. Could you maybe give us an idea of what's the actual current situation on the permitting process and the timeline and not for the major milestones on that process?
Okay, the milestones on the permitting is the first thing is to complete the environmental baseline work. We will have that actual field work completed by the end of this year. We'll complete that environmental impact assessment study as mentioned last year, compile the data, and then we'd be looking to file the applications. For that, however, we need a project description, and for that we need to finish the PFS first. So we're looking at that, early 2024 to have that all ready to start the permitting process.
Gotcha. Thank you. I'll jump back in the line. Thank you.
Okay, thank you.
Next question will be from Owen McCleary at Haywood Securities. Please go ahead.
Hi. Thank you for taking my call. So, Gary, on slide 30, I see you've indicated about 60,000 meters completed for infilling the drilling for the PEA. So, going forward, how many meters are planned for infilling for the PFS?
We've just received the PEA from Ausenco and Mining Plus, so we're just going through that number now. As mentioned, we've already done 60,000 meters of infill drilling. We've released some of that, but not all of that. We've released about 15,000 meters of that, so we do have outstanding results there. We're currently going through that drill program. We're probably looking at an additional 100,000 meters, and that's why we're looking at drilling through the remainder of this year and into next year as part of the PFS study.
Wonderful. And then I believe somebody mentioned that the PFS we're targeting 2024 for completion for that. Is that correct?
That's right. Early 2024, first half of 2024 looks like the date for completion.
H1 2024. And I know it shows here 2023, but it's likely to be H1 2024. Mostly drill constraint.
Okay, wonderful. Wonderful. Thank you for taking my call.
Thank you. Next question will be from Don Blythe at Paradigm Capital. Please go ahead.
Hey, Gary and team, congratulations. You certainly phased the project to keep the initial capital down, as you mentioned. Can you give a sense of the $886 million of sustaining capital? What's kind of the split between what you might consider phased development capital and sort of true sustaining capital?
Okay, I'll hand that to Jerry.
Look, they don't have the numbers in front of me, but a huge part of that is the stripping and the tails going forward. Okay.
And the underground.
Well, of course, underground starts in year 1 or year 2, so we do have that in there as well. The decline loan is going to be $35 million. But that probably $40 million before we even touch the ore. So lots of money costs.
Yeah. And that, of course, equipment we're leasing to buy initially, so we'll be purchasing that equipment over stage payments.
So
yeah,
that's great. With leasing over the period of the whole mine.
Okay, and any sense of what the sort of metric would be? Sort of the true sustaining, is that half of that or?
No, look, I think the true sustaining is a much smaller number.
Much smaller, okay.
The plant sustaining is in the millions. It's not in the tens of millions per year. So I don't have that number. We never actually dug that out, true sustaining, but it'd be much lower than that number.
Okay, so it is a lot of it is just pushed into the future rather than coming up with the cash up front.
100% right. That's why our initial capital looks low.
Yeah.
Because a huge portion of that is in the sustaining, especially in the first 3 years. So we think it's appropriate. I wish we had a slide showing the capital on a yearly basis. But.
Okay. Thanks.
That's right. Remember, you have ongoing development for the underground, and that goes on for the first 12 years until the underground is depleted, and then that capital significantly decreases after that on an annual basis.
Perfect. Thanks.
Thank you. Once again, as a reminder, ladies and gentlemen, if you would like to ask a question, you will need to please press star followed by 1 on your touch-tone phone. And your next question will be from Stephen Sook at Stifel GMP. Please go ahead.
Hi guys, congrats on putting out a great study here. Certainly getting a lot of attention. I was just wondering if you could provide some more detail on the work that went into that upfront capital number. I know you mentioned working with suppliers, but if you could just provide a little more color on kind of the work that went on there around equipment, earthwork, some of the major numbers that make up that 517, and as you said, some of the quote sustaining going into the first couple of years. Thanks.
Yeah, look, Gary, I can take that one if you want.
Yeah, look, there is a summary. I've just put it up here. There is a summary slide there that does break it out between. You've got your initial mining equipment there at Garrison is $63 million. The plant itself, the 7 million ton plant, is over $200 million. The infrastructure, this is the on-site. This is everything from water treatment to the initial tailings dam. Remember, we have currently proposed a wet tailings facility rather than a dry stack. So there's more capital in there. Off-site infrastructure includes bringing in the electricity, power. And then on top of that, the project indirects, first fills. You've got project delivery, that's your EPCM, and then got your owner's costs coming in there. So that that shows your indirects, directs there in regards to that. $570 million, and we've included $80 million of contingency for the level of study that we're at now. A PEA study.
Great, thanks. I guess we'll get a little more when the full report comes out as well. But you mentioned kind of other benchmarks in terms of scale and production scale. Could you talk a little bit more the benchmarking work or how you kind of arrived at that? Obviously, projects like Back River are less accessible, so some maybe opportunities or upside there versus the peers.
Yeah, exactly. Look, we're on a main highway just east of Timmins. There's a number of major projects, as you know, and currently in production and in development. We don't have many of the overheads many of the more remote projects have. There's no need, as Jerry mentioned, for a camp. There's no need for extensive haul roads, for very expensive, shipping, winter shipping, ice roads. So we can access this project all year round, and there's operating mills all around us and very skilled, workforce all within driving distance. So we don't see some of the overheads and additional costs you get with some of the other projects currently in production. However, we have trended, and I am showing the slide now that shows where we sit in regards to initial capital. And remember that we have pushed some of our initial capital through to sustaining, so we're quite competitive with those other projects in Canada being in development. And fortunately, for the first producing more gold on a per annum basis. So we feel that that's a very attractive project here in a very low risk environment.
Great, thanks. Just one more for me here, switching gears a little bit. You mentioned the 60,000 meters already ongoing drilling, looking at maybe another 100,000, but to be determined. Do you have a sense of what sort of split would be infill, so a small step out, versus kind of looking to extend the underground at depth or chase kind of additional high-grade underground resources?
Look, it's really all infill. It's all about upgrading from inferred to indicated. And when we're talking infill, we're talking infill between, current stopes where we actually have intercepts. There just wasn't enough drilling to support a resource. We're talking infill within the open pit at, Windjammer South, drilling through that banded iron formation units and the sedimentary package in between. Infill at 903, we have a significant part of that pit which has not been drilled out. Westaway as well, and remember we didn't think Westaway was going to pull a pit before, and now it does. So it was never drilled out on as a open pit drilling scenario. So we've got large areas in there that haven't been drilled out. So we'll be targeting those as part of the PFS. And of course, targeting areas where we've got good grade and looking to extend grade as well as lower strip ratio. So it really is all about expansion of current economic ounces.
Great. Okay. Thanks for answering my questions. I'll pass the mic over to someone else.
Thank you, Stephen.
Thank you. At this time, Mr. O'Connor, we have no other questions registered. Please proceed with closing remarks.
Okay, thank you. And we want to thank everyone for taking the time to attend our conference call today. As we've mentioned, we see this as a highly attractive project moving forward. Good low capital, good attractive cash cost, all-in sustaining costs, very good gold production for the first 11 years, the ability to expand beyond that, good grades and very low risk, and a good payback period in a very safe jurisdiction and a great location. So thank you for your support and your ongoing support going forward. We're looking to continue to deliver and do well by our stakeholders. Thank you.
Thank you, sir. Ladies and gentlemen, this does indeed conclude your conference call for today. Once again, thank you for attending. And at this time, we do ask that you please disconnect your lines.